Investing tips for 20s. Investing in your 20s is a great way to set yourself up for financial success in your 30s and beyond. Here are some steps you can take to make sure you're on the right track. Start early. The earlier you start investing, the more time your money has to grow. Even if you can only afford to invest a small amount each month, it can add up over time. Starting early means investing as soon as possible. The earlier you start, the more time your investments have to grow, and the more money you can potentially accumulate over time. For example, if you start investing at age 25, you'll have 10 more years of compounding returns compared to someone who starts investing at age 35. Compounding returns refers to the fact that your investment gains can earn additional returns, which then also earn returns. Over time, these small gains can add up to significant wealth. So, don't wait until you have a lot of money to start investing. Even if you can only afford to invest a small amount each month, start as soon as possible. The longer you wait, the more you'll miss out on potential returns. Understand your risk tolerance. Different types of investments carry different levels of risk. It's important to understand your risk tolerance and invest accordingly. Generally, the younger you are, the more risk you can afford to take. Understanding your risk tolerance means knowing how much risk you're comfortable taking with your investments. Different types of investments carry different levels of risk. Generally, stocks are riskier than bonds, and international stocks are riskier than domestic stocks. Your risk tolerance depends on a number of factors, including your age, income, investment goals, and personal preferences. Generally, the younger you are, the more risk you can afford to take, since you have more time to recover from any losses. To determine your risk tolerance, consider your investment goals and your comfort level with volatility. If you're investing for the long term and can handle short-term losses, you may be able to tolerate more risk in your portfolio. However, if you're investing for a short-term goal, like a down payment on a house, you may want to invest in less risky assets to avoid losing money in the short term. It's important to find a balance between risk and reward that works for you. Don't invest in assets that make you uncomfortable or keep you up at night. Instead, invest in a mix of assets that align with your goals and risk tolerance. Invest in a diversified portfolio. Investing in a mix of stocks, bonds, and other assets can help you spread your risk and potentially earn higher returns. If you have questions, comment down below. Investing tips for 20s. Investing in a diversified portfolio means spreading your money across a variety of different investments. The diversified portfolio can help you manage risk and potentially earn higher returns over the long term. Diversification means investing in different asset classes, such as stocks, bonds, and real estate, as well as different industries and sectors. It also means investing in different geographies, such as international stocks, to reduce your exposure to any one market. By diversifying your portfolio, you can reduce your risk of losses in any one investment. For example, if you only invest in one stock and that company performs poorly, you could lose a significant portion of your investment. But if you invest in a diversified portfolio of stocks, bonds, and other assets, a loss in one area can be offset by gains in another. Diversification can also help you capture different sources of return. For example, while stocks tend to offer higher returns over the long term, bonds can offer more stability during market downturns. By investing in both, you can potentially earn higher returns while managing risk. Overall, a diversified portfolio can help you achieve your investment goals while managing risk. Consider working with a financial advisor to help you create a portfolio that aligns with your risk tolerance and investment objectives. Take advantage of tax-advantaged accounts. Retirement accounts like 401ks and IRAs offer tax benefits that can help your money grow faster. If your employer offers a 401k match, be sure to take advantage of it. Taking advantage of tax-advantaged accounts is a smart way to save for the future while reducing your tax burden. Retirement accounts like 401ks and IRAs offer tax benefits that can help your money grow faster. Contributions to these accounts are made with pre-tax dollars, which means you can reduce your taxable income and lower your tax bill. For example, if you earn $50,000 per year and contribute $5,000 to a traditional IRA, your taxable income would be reduced to $45,000, potentially lowering your tax bill. In addition to the tax benefits of contributions, the investments in these accounts grow tax-free until you withdraw the money in retirement. This means you can potentially earn higher returns on your investments, as you won't have to pay taxes on the gains each year. If your employer offers a 401k match, be sure to take advantage of it. A 401k match is free money from your employer, which can help you reach your retirement goals faster. For example, If your employer offers a 50% match on the first 6% of your salary, and you earn $50,000 per year and contribute $3,000, 6% of your salary, your employer would contribute an additional $1,500, giving you a total of $4,500 in savings for the year. Overall, taking advantage of tax-advantaged accounts can help you save for the future while reducing your tax burden. Consider working with a financial advisor to help you determine which accounts are right for you and how much you should be contributing to each. Keep your fees low. Investing fees can eat into your returns over time. Look for low-cost investment options like index funds and ETFs. Keeping your fees low is an important part of investing, as fees can eat into your returns over time. When choosing investments, be sure to pay attention to the fees charged by the investment products you are considering, including expense ratios, transaction fees, and account maintenance fees. Expense ratios are the ongoing fees charged by mutual funds and exchange-traded funds, ETFs, to cover the costs of managing the fund. These fees can range from as low as 0.03% for some index funds to as high as 2% for some actively managed funds. Over time, high expense ratios can significantly impact your investment returns, so it's important to choose low-cost investment products whenever possible. Transaction fees and account maintenance fees are charged by brokers and investment platforms. These fees can add up over time, especially if you are an active trader. Look for brokers and investment platforms that offer low or no transaction fees, and be aware of account maintenance fees that may be charged based on your account balance or activity. Another way to keep your fees low is to invest in passively managed funds, such as index funds or ETFs, which aim to track the performance of a specific market or index. These funds typically have lower expense ratios than actively managed funds, since they require less research and analysis. Overall, keeping your fees low is an important part of investing. By choosing low-cost investment products and avoiding unnecessary fees, you can potentially increase your investment returns over time. Stay disciplined. Investing requires patience and discipline. Stick to your investment plan, even when the market is volatile. By following these steps, you can set yourself up for financial success in your 30s and beyond. Remember, investing is a long-term game, so be patient and stay focused on your goals. To learn more about life, business, and technology, subscribe to this channel. See you on our next video.